Okay, so let's have a look at the last adjustment 8 for Melba Ltd 2015. So you're talking about the directors recommended that provision be made for investment income and debenture interest due. So we've them done already as part of our workings, and I'll show you where they are. Provision for bad debts to be adjusted with 4% of debtors. So you need to adjust that and provide a provision for bad debts. Buildings to be depreciated at 2% of cost. So you would have adjustment done for buildings. You just have to take that new figure and get 2% and also look to see if there's any land. And then the managing director should be paid a bonus commission of 3% on sales of excess of 90,000 and a further 5% on sales in excess of sales above 1.2 million. So you need to calculate that for the commission expense for the profit and loss account, and the expense that goes into the balance sheet is a current liability. So the first one then, provision for your investment and investment income due. So remember, we would have that done already as part of our adjustments up here. So when there's a patents, remember I said I always put them in as part of here. So it's usually my second step. So the investment income due. So that's our investment income due completed. And then our mortgage or debenture interest then will be part of the suspense. So I always kind of keep them together because I know they're going to be used later on or asked from later on. So you might as well do them here. So everything's nice and kind of easy to find. So you got your debenture interest for the second part as part of your suspense adjustment. So the next one then, from the question then, provide provision for bad debts to be adjusted 4% of debtors. So we need to find out what is our debtors figure. So our debtors figure is 94,800. So we're going to do a working for that. So it's 94,800. And it's 4%. So 3,792 is our new provision. So you want to see is this an increase or decrease. So that's going to go into your balance sheet as a current asset, take away from your debtors. So our new provision then is this 3,792. We're going to see if there's an or provision or whether this is an increase or decrease. So we're going to go to our trial balance, have a look for a provision. So to have a bad debt provision of 4,000. So this is a decrease. So if it's a decrease, it's extra money we're going to receive. So we're going to get an extra 208. So that's going to go to your profit and loss. And it's going to be add operating income. So it's an extra 208 that we didn't think we were going to get, but we are. If that was an increase, it'd be an expense. So if this 208, if our provision for bad debts was going to be more than 4,000, that would be an increase, and that would go into a profit and loss then as an expense underneath your selling and distribution. So with that provision for bad debts, two things you want to calculate what is the new provision. It's going to be taken away from your debtors in your balance sheet. And then you want to create, is that an increase or a decrease? So we've calculated it's a decrease. So we find the new figure for provision for bad debts that we just calculate as part of this working. And then you're going to go to the trial balance and see what the old provision was. So the old provision in this question was 4,000. So what we need to do then is find the difference. So we can see it's a decrease. So that's going to be extra money that we're going to receive, which is going to be added to your operating income. The next one for this one is doing your depreciation on buildings. So we're going to have a look and see what's our new figure for buildings. So we're just going to have a scan back. So our buildings is 700,000. Remember, we'd VAT as part of that. So your buildings is 700,000. And you're multiplying the rate of depreciation from the question is 2%. So our depreciation then, that goes into your profit and loss and goes into your balance sheet as part of your accumulated depreciation. It's going to be 14,000. So that 14,000 goes into your profit and loss underneath admin, and it's also going to go into your balance sheet as part of your tangible assets in your accumulated depreciation section. So the last part of that adjustment then is the managing director should be paid a bonus of 3% on all sales in excess of 900,000 and a further 5% in all sales in excess of 1.2 million. So two parts to that. First of all, we're going to find out what are our sales, because remember, commission is based on sales. So our sales are 1,495,000. So we're going to do two parts to it. So you got 1,495,000 minus 900, and then we got 1,495,000 up to 1.2 million. Okay, so we're finding out how much he's earned above 90,000 or 900,000 and how much he's earned above 1.2 million. And this first one above 900,000 is going to be at a rate of 3%, and the one above 1.2 is going to be a rate of 5%. So this is going to be your 3%, and this one here is going to be your 5%. Okay, so what we're trying to do is find the difference, or find a figure that you need to calculate on. So the difference between 900 and 1.5 million is 1.495 million. Okay, so 595,000. That's going to be multiplied by 3%. And then for the 5%, and the difference between 1,495,000. So 295,000 then is going to be multiplied by 5%. So 595 multiplied by 3%. So what was above the 90,000? So between 90,000, 900,000 and 1,495,000. So that earnings that he earns, between those he's going to get 3%. So he's sold 595,000. So he's going to get a commission of 17,850. So remember, commission is based on your sales. So it kind of gets the people kind of an incentive for them to sell more. The more they sell, the more commission they're going to get, which is kind of an extra payment on their wages. He's going to get 5%. So between 1.2 million and 1.495 million, which is 295,000, he's going to earn 5% on that, or they're going to earn 5% on that. So it's 295,000, multiply that by 5%. So it's 14,750. So these two figures added together. So 3% and 5%. Those two added together is going to be their total commission. So 32,600. That's how much you need to pay them in commission, and that's going to be expense to us. It goes into the profit and loss in your selling and distribution, and also going to go into your balance sheet as a current liability or creditors due in 1 year, because that's how much you have to pay for it. So a little bit to that adjustment based on the commission, all sales in excess of 90,000. So we got 90,000. We took it away from the sales, which is 140 or 1,495,000. So that excess was 595,000. They're going to receive 3% on that. So the commission they're going to receive is an extra 17,850. And then from the question then, it said that a further 5% in excess of sales over 1.2 million. So over 1.2 million, so between 1.2 million and the sales, which is 1,495,000, it's 295,000. And that's going to be 5%. So they're going to earn 14,750. So the total commission they're going to receive is the commission for 3% and the commission for 5%. So that's going to give you 32,600. It's going to go into your profit and loss account as a selling distribution. And it's also going to go into your balance sheet as a current liability because we have to pay it. And that's how you do the last adjustment, adjustment 8 for Melba 2015 company question.